Mickey Dickey here, giving you my weekly wrap up for the end of April 7th. Now, please understand today is Friday and the market is closed for Good Friday. So what I've done here, and hopefully everybody's keeping track of this because I'm updating my Excel spreadsheet to hopefully make it make a little more sense for everybody. And what I'm doing is showing the monthly trend of what's going on each particular month, and then giving you the current weekly trends on what's happening here. For the end of March, we ended up with 6%. 3.5 and 1/8. For the first week of April, we lost 1%, 1.1 in the NASDAQ. We're down 0.1 in the S&P and up 0.6 in the Dow. And those of you who listened to my video from last week, I was saying is that I was hoping this week would be kind of level and just not sell off big. And part of that reason is that we had a bunch of things come out this week that I was a little bit concerned about as far as how the market would react to them. So going forward, as we look at these trends, year to date, we're up 15 in the NASDAQ, almost 7 in the S&P, and 1 on the Dow. Now, what that means in the scheme of things is that the NASDAQ is still down almost 25% from its peak. The S&P is down 14 and the Dow is down 9. The NASDAQ is actually up almost 20% from its bottom, 17 for the S&P and 16 for the Dow. Now, as we continue to say, because of this disparity, as these indexes continue to move towards getting back to their peak, the NASDAQ's going to have to continue to go faster than the S&P and the S&P faster than the Dow. So these should widen out as that happens. So those trends continue to work as we expect them to. Again, January was big, February was down, March started off down because of the SVB, but made a huge recovery. Now going into next week, we've got the CPI and the PPI coming out on Wednesday and Thursday. We also have the minutes from the Fed. So that's going to be an interesting little triad, so to speak, in there. But what I found interesting this week was that the ISM report came in lower, the ADP number came in lower, and we had another jobs report come in lower, and then we had a report from today. And we're going to ignore it today just for a moment because the market's not open. But what I found interesting is that all the reports that came out this week were actually showing that the economy was slowing. And for the last year and a half, pretty much any report that came out that showed that the economy was going up and being strong, the market sold off because they thought the Fed was going to have to continue to raise rates. And then if we had a report that showed the economy not doing well, they thought that the Fed wasn't going to raise rates anymore, but lower, the market went up. And yet, throughout the beginning of this week, the market just sold off. In fact, for the first 3 days of this week, it just went down. Now, yesterday, we had a report that came out, which was actually, again, good because it was slowing but not bad, which is what we've gotten on all these reports. And the bond market continues to push down. And the market originally sold off and then ended up today up, which was, again, what should actually happen is it should actually be up with what happened yesterday. So it's going to be interesting to see what happens on Monday and Tuesday when everybody comes back and tries to digest the report that came out today. And the report that came out today shows unemployment at 3.5, which is still lower than it was when Powell started back in November of 21, when it was 3.7. And it's showing that things are still slowing, maybe not to the speed with which everyone wants them to be, but unemployment is still not going up. And I continue to say this, and until somebody can prove to me otherwise, and I don't know how you can prove it, a good labor force and a good economy is never a bad thing. So unless inflation next week goes up for some unknown reason, I don't see how this is a problem. By definition, if we can raise interest rates to get inflation down, which, as I've said before, I don't know that was necessarily necessary to get inflation down, but it's what we're doing. But if we've raised rates and we get inflation down and unemployment stays under 4, is that not the definition of a soft land? And everyone seems to ignore this. And I've even had a couple people on television come out and say, if you're doing this, you're an idiot or you're not understanding, and people that are in the know. No, the simple facts are simple. And sometimes we try to make them very, very complicated, and they don't need to be. If we have 3.5 unemployment and we get inflation down like most people think to 3.5% by, let's call it August, how is our economy still strong a problem? I don't get it, which I will continue to say this again over and over. It took 16 months to get inflation up to 9.1%. If it takes us 16 months to get it back down, that's just reasonable. I don't like it. Okay, I'd love it to come down in a day, but things don't work that way. If they take 16 months to get to a peak, they're going to take at least 16 months to come back down. That's just a normal thought process. We'd love it to come down better than that, but it's not going to. We don't expect it to. Which brings me to my next point, and I've said this again, and I'll continue to beat it till everybody understands it. Powell is not saying that unemployment has to go up. He is saying that it might go up, and statistically, and when you put models together, if you raise interest rates, unemployment should go up. It doesn't have to. Just look at what's going on in the economy. Rates are going up, and unemployment isn't going up. So you don't have to have unemployment go up with inflation going down because they're raising interest rates. There doesn't have to be a correlation. Again, just because something has happened in the past doesn't mean it's going to do the same thing in the future. The same thing with stocks. We all talk about it all the time. Just hate the fact when we ignore the actual facts and make up our own stuff, which is really what it seems to be we're getting on the news every day. They just make stupid stuff up, which is why I give you the actual facts on this, because I want you to have some place to go where you're going to actually get the facts, not some made up baloney. Again, I'm not trying to beat up anybody, but I wish someone would just stick with the facts rather than making their own commentary and making stuff up just to make it fit a narrative they wanted to say. The facts are these. We still have higher inflation, but it's coming down, which is what's to be expected. We started lowering rates in March of last year, or raising rates to lower inflation in March of last year. And by August, which would be 17 months, we're back down to 3.5%. And it took 16 months to get there, back up to 9. Seems like a normal course of events. But the facts are the economy is still strong. Yes, it's weakening a little bit, but again, everything goes up and down. Nothing goes straight up forever, and don't expect it to. Powell doesn't. So focus on what's actually happening in the world rather than what you're hoping to happen or what maybe possibly could be happening. If you were listening to what was going on in the economy or on the news every day, you'd have missed out on the fact that the NASDAQ is up almost 16% this year. As I tell my clients, you have to be invested in order to make money. And yes, sometimes things go down and they don't go the way you want. But if you're not in the market, you can't make it either. And yes, you're only up 1% in the Dow, which if you listen to all the idiots on television, they would have told you in December that 23 was going to be the exact same thing as 2022. It's the complete opposite of it, which again, I don't know why anybody thinks everything is going to go exactly that way. Again, you look at the statistics, you look at what's actually happened in life and in the stock market, it doesn't work that way. Not every stock goes down forever and not every stock goes up forever. They go up and they go down, which means the market does exactly the same thing. And when you look at how often the market has gone down 2 years in a row, it isn't much. So when you were down 36, 38% last year in the NASDAQ, the odds of that happening again the next year aren't great. Again, not that it can't happen. And that's why I always tell people, just look at what's actually going on. Is this going to continue to happen? I don't know. But I know what's going to happen with this is it's going to be based on real data and what's really happening in the world and how the market responds to it. Now, I do want to make this point. I'm going to start this now because it's something that's going to have to happen. At some point, the Fed is going to stop. Whether they stop on May 3rd or not, I don't know. But at some point, negatives will be negative. Because if things continue to deteriorate, that means that it's not just doing what Powell wants it to do, it's actually doing damage. Right now, the market's still strong, it's slowing, unemployment's still strong, and nothing has really gone totally crazy. Now, we have broken a few things in the banking industry, but again, nothing irreparable and systemic. So the market should continue to look at these things that are slowing, and hopefully if inflation goes down on Wednesday and on Thursday, the market should respond to that in a positive way. But if it continues and it gets to be too much, you're going to start hearing people talk about the fact that the Fed is too slow in slowing and reducing interest rates, which is weird because literally one day they'll say that they're still behind and have to continue to increase, and the next day they're going to finally come out and say the opposite. Again, deal with reality. And I'm not saying that there won't be a time to pull some money off the table. The market should take what's going on here as a positive, and we'll just have to see how the market goes down the road and how it takes next week. So again, get with your financial advisor, see where your portfolio needs to be based upon what's coming up. With the banks, it's going to be interesting to see how they're performing, because it's going to be majorly large banks coming out next Friday, and how much disruption what happened with SVB really affects them. And then we'll start seeing the regional banks the following week to see how that goes. So overall, keep focused, get with your advisor, make sure your plan is focused on your goals and getting you to your retirement, when you want to retire and how you want to retire, because that's always my goal. Dickie out.